Right. Let's talk about interest rates. Higher interest rates in the US usually hurt emerging markets, and that's because investors pull their money out of the markets and return to the US for better returns. However, when the US Federal Reserve lowers rates, it can have the opposite effect, benefiting emerging economies by attracting renewed investment. Hello, and welcome to Daytopia Wealth and Research, where we transform your everyday news into financial opportunities. Kindly subscribe and follow our page to stay updated.
My name is Dr. Yusuf. I'm a financial expert. I'm a qualified financial advisor and a chartered accountant for over a decade. Disclaimer, this is not a financial advice. If you need further financial advice, first of all, make your own research and you have to consult a financial advisor.
So let's get right into the update. In September, the Fed cut its key interest rate by 0.50%, marking a significant shift in its approach to managing the US economy and inflation. Experts from JP Morgan and Fitch Ratings predict that Fed may even cut rates more times by the end of 2024, possibly into 2025. Now, lower US rates can lead to an increase in capital flowing into the emerging markets. Explain that further. As the US dollar weakens, global commodity prices, which is an important factor for many emerging economies, tend to rise. Okay, let's look at an example. Indonesia Central Bank, for instance, they often follow the Fed's lead when adjusting their interest rate. So following the Fed's rate cut, the Indonesian rupiah appreciated significantly, allowing Bank of Indonesia to lower its rates comfortably. Other Southeast Asian currencies like the Malaysian ringgit, the Singapore's dollar, also strengthened after the Fed's decision. On the 29th of September, the Thai baht reached its highest value against the US dollar since early 2020. Now, let's go into the financial opportunities. The first one is that there is increased foreign investment. Lower US rates can encourage foreign investors to seek better returns in the Southeast Asian market, leading to increased FDI, that's foreign direct investment, in sectors like technology, infrastructure, and manufacturing. Also, as capital flows into Southeast Asia, local currencies may appreciate. What that means is that a stronger currency can lower the cost of import and help reduce inflation, which benefits the consumer and businesses. The third opportunity is that many Southeast Asian economies rely on commodity exports. So a weaker US dollar can drive up global economic prices, which increases the revenue for exporters in agriculture, minerals, and energy. The last opportunity is for local businesses because increased foreign investment and consumer spending can create opportunities for local businesses to grow and innovate, especially in technology, e-commerce, and sustainable industries. As the US reduces interest rates, Southeast Asian emerging markets stand to gain from increased investment and stronger currencies, thereby contributing to their economic growth. So for our Forex investors, make sure you keep an eye on the Southeast Asian currencies and the US interest rates. Thank you and see you next week.